What is a conventional loan? Well, I'm glad you asked, and welcome back to the channel. My name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgages and home loan financing, you're in the right place. Subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan or get connected to a great real estate agent, check the description below or leave us a comment. We'll be sure to get to your comments as soon as possible. So as I mentioned, we're going to do an overview of what a conventional loan is and why you might want one. And we're going to do that by reviewing these 4 key topics. Number 1, we're going to provide an overview of what a conventional home loan is. Number 2, we're going to explain the key features of conventional home loans, some criteria for eligibility, and discuss a few of the pros and cons. Number 3, we'll discuss loan limits for conventional home loans and do a brief comparison to FHA. And number 4, we'll wrap up with a brief conclusion. All right, so let's jump into it. Number 1. So by the end of this video, you're going to have a great understanding of what a conventional home loan is and why you might want one. So a conventional home loan is something that's not insured by the federal government, meaning it's not an FHA loan and it's not a VA loan, and the insurance helps mitigate some of the risk. So you've likely heard of Fannie Mae and Freddie Mac. They are the underwriters that determine the guidelines for conventional home loans. So conventional home loans are backed by private lenders, and therefore you have to qualify for a specific set of guidelines, like I said, that are provided by both Fannie Mae and Freddie Mac. Jumping into segment 2, we're going to review some key features, some eligibility criteria, and a few of the pros and cons of conventional home loans. So let's start with some of the key features. So the first one to note is conventional home loans require a minimum credit score, typically of 620. Now, to expound on that a little bit, just because the guideline allows for a minimum score of 620 doesn't mean we'll actually get an approval with a score that low. So just keep that in mind. Another key feature of a conventional home loan is a minimum down payment. Now, conventional home loans will allow you to have a down payment as low as 3%, but it's typical that if you're going to get a conventional home loan, you're going to want a higher down payment. So somewhere in the range of 10 to 15 to even 20%. There's no maximum down payment, right? So if you wanted to put down a 50 or even 60% down payment, your risk is much, much lower because you've brought additional cash to the table, right? You've put much more skin in the game. In other words, the more down payment you bring, the more favorable your loan terms will be. One thing I always like to mention is bringing a larger down payment can cover up or help mitigate other risks, such as lower credit scores or maybe even a higher debt to income ratio. So if you bring a larger down payment, you're putting more skin in the game, and thus you're making yourself a less risky borrower, and you have a much higher likelihood of having your conventional loan approved. So conventional loans offer both fixed rate, which is most common, as well as adjustable rate terms. Now, for the purpose of this video, we're going to focus on fixed rate loans. We'll provide other content in the future specifically about adjustable rate mortgages. So the most common conventional loan is the 30-year fixed mortgage, which means your interest rate and your principal and interest payments are fixed for the life of your loan, which is up to 30 years. And honestly, the 30-year fixed mortgage is worth thinking and pondering about just for a quick second. It truly is amazing that you can borrow money at an interest rate that's fixed for a full 30-year time period, and your housing payment will effectively not change for the life of your loan. But what will change in your benefit is most likely your income will increase and your house value will most likely increase over that period of time. So over the period of up to 30 years, the housing expense that you have actually decreases as a percentage of your monthly income, and your house value will increase at the same time. So it really is amazing. And frankly, it's probably the #1 wealth generator for American families. One thing we haven't touched on yet is occupancy. So you can use a conventional home loan to purchase or refinance a primary residence, a second home, which could be used for a vacation property, or an investment property with up to 4 units. And that would be for purposes of renting out that property to tenants. It's worth mentioning that loan terms are favorable for buying a primary residence. That's because as the borrower, you're going to occupy that home and take care of that home and live in that home, right? Somebody who lives in the house is far more likely to take good care of the home and make their payment on a monthly basis versus somebody who may only visit the property once every couple months if it's a vacation home, or somebody who may never visit the property at all if it's an investment property, right? So if push came to shove and you were short on money, what is the payment that you're most likely to make? Well, probably the payment on the primary residence in the house that you live, right? So long story short, the primary residence is going to have the most favorable loan terms because in theory, it's the lowest risk to default. It's also worth noting that if you're interested in buying an investment property or a second home for vacation purposes, your down payment minimum is going to increase and the criteria for qualification will be a little bit tighter as well. And that also is directly related to the fact that it's just a higher risk loan. Last but not least, if you wanted to use a conventional home loan to purchase a multifamily property of either 2 to 4 units, there was a recent guideline change that is really in your favor. Now, that being said, the guideline changes specific to buying a multifamily home of 2 to 4 units. But the kicker is you have to occupy one of the units as the buyer as your primary residence. And if you do so, you can actually purchase that up to 4-unit property with only a 5% minimum down payment. That's a massive improvement versus the minimum 15% down payment that used to be required. All right, moving on to finish out this section, let's talk about the debt to income ratio, often called the DTI. So conventional home loans have tighter debt to income ratio limits than an FHA loan, for example. So typically we want to see a debt to income ratio of about 43%. And you might be saying, what's a debt to income ratio? Well, when we look at measuring and calculating debt to income ratio, we're going to look at your gross monthly income, and then we're going to look at your credit report. And on that credit report is going to be a list, a comprehensive list of liabilities, and each of those is going to have a minimum monthly payment. So if we add up all of those minimum monthly payments on your credit report, plus your prospective mortgage, right? So your principal and interest, your taxes, your insurance, your mortgage insurance, if applicable, HOA dues, if they're applicable, we're going to add those all up, and we're going to divide that by your gross monthly income. That will give us a percentage. On a conventional loan, a good target is about 43% on the ceiling. Sometimes we can flex up to a higher debt to income ratio on a conventional loan, but it's going to depend upon other factors like credit score as well as your down payment. So to kind of wrap up that section, if you've got a debt to income ratio of 43% or less, you might be a great candidate for a conventional home loan. Just want to pause the video for a quick moment and invite you to connect with us. If you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below. All right, let's jump into a few of the pros for a conventional home loan. So the first is mortgage insurance. So mortgage insurance probably is not a pro in anybody's mind. And if you don't know what mortgage insurance is an additional insurance policy that the lender requires you to pay for as the borrower when you have less than a 20% down payment. Now, how could that be a pro? Well, the cool thing with conventional home loans is that if you have favorable credit score, or if you have a little bit more down payment, or if you have a lower debt to income ratio, then your mortgage insurance, your PMI, your private mortgage insurance can actually be less and less of a burden on a monthly payment basis, right? Whereas if we briefly just compare it to FHA is something called MIP, and that insurance rate, that payment is going to be the same for anyone, regardless of credit score, debt to income ratio, and it'll vary slightly depending on down payment. But by and large, if you have less than a 20% down payment, but really great credit, potentially maybe a little bit more than a minimum down payment, as well as a lower debt to income ratio, you can get more affordable mortgage insurance with a conventional home loan. Another favorable part of mortgage insurance with a conventional home loan is that it can go away as you pay down your loan balance. So let's say you bought a house for $100,000. Let's say you put 10% down, meaning your loan is $90,000. When you pay your balance of your mortgage down to $80,000 and you have an 80% loan to value, you can call your servicer and request that your mortgage insurance be canceled. As soon as you pay that loan balance down to $78,000 in this example, meaning your loan to value is 78%, your mortgage insurance is automatically canceled, which is awesome. That's not true for FHA. All right, so continuing on here with our list of pros of conventional home loans. One of those is the opportunity to potentially get a lower interest rate. And that would be because you may have a higher credit score, a lower debt to income ratio, and or a larger down payment. Another benefit of a conventional home loan would be no upfront funding fee. So with government loans, either VA or FHA, there's typically going to be an upfront mortgage insurance funding fee that you're able to finance into your loan amount. So you're not necessarily bringing that to the closing table at closing, but it's being bolted onto your loan amount and therefore gives you a slightly higher mortgage payment from a principal and interest standpoint for the life of your loan. With conventional loans, there is no upfront funding fee, so you can avoid that cost. Last but not least, conventional home loans do have higher loan limits than their government counterparts, meaning they can be suitable for higher priced homes. All right, let's just review a few of the negatives or cons of a conventional home loan. So we briefly mentioned this, but they do have stricter eligibility criteria, meaning you do have to have a lower debt to income ratio, ideally a larger down payment, and almost certainly a higher credit score in order to qualify for a conventional home loan. So double clicking just a little bit on the higher down payment. So you can get a conventional home loan with as little as 3% down, but as I mentioned before, your likelihood of being approved with a 3% down payment is less likely, more challenging. So as your down payment increases, your likelihood for approval is going to increase. So therefore, kind of by definition, conventional home loans to get approved are going to require a higher down payment typically than an FHA loan would require. And then kind of last but not least, we've already touched on mortgage insurance, but obviously mortgage insurance we talked about as a pro. Well, it's still a con because it's still a cost, right? So if you get a conventional home loan and you have less than a 20% down payment, you are going to have monthly mortgage insurance, and that will be in place until you've paid your loan balance down to at least 80% of the purchase price. Now, you can call your servicer and try to petition to get out of your mortgage insurance based on the value of your home increasing. They may or may not work with you. Typically, the best way to get out of mortgage insurance is to pay your loan balance down, or potentially just do a refinance because the house value has gone up. So kind of just to wrap up on mortgage insurance and kind of close up on this section. So generally speaking, if you have less than a 20% down payment, it almost doesn't matter what loan product you have, you're gonna have one form of mortgage insurance or another. Now, VA is a different loan product that potentially you can finance up to 100% of that value. This isn't the right video to talk further about VA, but that is kind of the one instance where you can avoid monthly mortgage insurance. All right, moving on to section 3, we're going to talk about loan limits further. We're going to talk about some market considerations, and we're going to do a brief comparison to FHA, which we've already mentioned before. All right, so moving on to loan limits. Conventional loans have a loan limit maximum, and that varies by year to year. So for the sake of this video having some longevity, we're not going to specifically mention what the loan limit is today, but just note that there is a national limit, and then there is an increased limit for higher cost areas. So if you think of Hawaii, or if you think of some of the coastal markets on either the West Coast or the East Coast, right? Seattle, San Francisco, LA, New York, Boston, et cetera. Those are going to be some higher cost areas, meaning the conventional loan limits in those markets will be higher. So if you have questions at all about what your conventional loan limit might be for any market you're interested in, just go down to the description below, find our contact information and hit us up, or leave us a comment and we'll be sure to get you whatever loan limit information you might need. So let's say you want to buy a house that is more than the conventional loan limit. So let's say for fun, we'll just make it very obvious. You want to buy a $2 million home and you want to put 20% down. So $2 million home with a 20% down payment, that's $400,000. That's a loan limit of $1.6 million. Almost always that is going to be outside of the conventional loan limit. So in that case, you're going to be pushed into something called jumbo. Again, not the place for us to talk specifically about jumbo, but just know that where conventional has potentially a little bit stricter criteria than FHA, jumbo is going to have even more criteria. So like I mentioned before, find our contact information below, leave us a comment. We'll be happy to help discuss any scenario you might have. All right, let's wrap up this section with just a really brief comparison of conventional loans versus FHA loans. So one of the real big differences is conventional loans are backed by private investors and the guidelines are set by Fannie and Freddie, right? We talked about that. Whereas FHA loans are backed by the government, meaning that they insure some of the risk and take on some of that risk, which makes FHA loans more accessible to folks with lower credit scores, lower down payments, higher debt to income ratios. So because FHA loans are insured by the federal government and they will allow for a higher debt to income ratio, that means borrowers can often have a larger purchasing price, right? So if you think about a debt to income ratio maximum for conventional of maybe about 43%, FHA can often flex up to 50%, right? So if you can have a higher debt to income ratio, then typically with an FHA loan, that means you can have a higher purchasing power. You can buy a more expensive home. Now, one of the things I'd said was that FHA may allow you to buy a more expensive home if you have a higher debt to income ratio. Well, I should clarify. FHA loans typically have a loan limit that is less than a conventional home loan. So if you are looking to max out the conventional loan limit, then you're going to fall short of that with an FHA loan. So an FHA loan is going to allow you to have a higher debt to income ratio, but it will not allow you to borrow as much money. So again, like I mentioned, we're happy to provide you those FHA loan limits by any area or market. If you're interested, just leave us a comment below or reach out by finding our contact information below in the description. All right, last but not least, FHA loans, we haven't really touched on this much. They also require mortgage insurance. It's called MIP, which is the mortgage insurance premium. It's not privatized, meaning it doesn't matter what your credit score is, what your debt to income ratio is. It does vary slightly by down payment, but if your down payment's less than 10%, your mortgage insurance rate is going to be the same no matter what on FHA. And the big bummer is mortgage insurance on FHA loans is in place for the entire life of your loan. Now, that being said, the FHA loan is an awesome loan for a get-in loan, meaning it helps you get into the house, it helps you purchase it, and then ideally what you do is you make your payments, you pay down your loan, and then the market value of your home will increase. Therefore, your loan to value, as you pay your loan down and as the house value increases, your loan to value will actually decrease. as you pay down your loan and as your house value improves. So ideally what happens is we use an FHA loan to help you get into the house. Then as your loan to value improves, we would refinance you into a conventional loan, getting you out of your mortgage insurance. Because remember, on FHA, mortgage insurance lasts for the life of the loan. Now, one last thing to note about FHA mortgage insurance, if for some reason you have a 10% down payment and use an FHA loan to purchase a home, that mortgage insurance is not in place for the life of the loan, but rather for 11 years. So a conventional home loan is an awesome product for someone who may want to hold their loan a little bit longer. And that would be specifically because you can actually get out of your mortgage insurance, right? So if you purchase the home with less than a 20% down payment and have mortgage insurance at the start, as you pay your loan down and as the house value increases, you have the opportunity to get out of your mortgage insurance. So conventional might be a better product for somebody who wants to hold their loan a little bit longer versus viewing it as a short-term get-in loan. All right, my hope is that this video answered all of your questions about conventional home loans. But of course, if you still have questions, we'd love to connect with you. Scroll down to that description, find our contact information, leave us a comment. Like we mentioned, we'll be getting back to you on those comments ASAP, and we look forward to getting all of your questions answered.